How an incredible account receivable collateral loan can save your business. Call 888-653-0124 today or click the link in the description to learn more. An account receivable collateral loan is a type of financing that allows businesses to borrow against their accounts receivable. They lend money to companies based on the amount of money owed by customers. Many small businesses don't realize that they can take advantage of the benefits of an account receivable loan. They think that only large corporations can benefit from such loans. However, there are plenty of reasons a small business owner should consider using an account receivable loan to fund their company. Here are the main reasons a small business can benefit from taking out an account receivable loan. Account receivables loans. What they offer. And how to use them. An account receivables loan is a short-term financing option designed to help businesses pay off past due invoices. These loans are typically used when a company could not collect enough money owed to them from clients. They're ideal for small businesses because they don't require collateral, meaning there's no need to put up any assets as security. This makes them perfect for companies who don't have access to bank funding. However, these loans come with some risks. The interest rates can be quite high, and the repayment period can last anywhere from 3 months to 2 years. That said, account receivables loans offer several benefits over traditional bank loans. First, they allow you to avoid paying interest during the term of the loan. Second, they can be paid back, allowing you to use the funds quickly. Third, they rarely require collateral, making them a great way to finance your business. If you're interested in learning more about this type of financing, contact us today. We'd be happy to answer questions you may have and show you how we can help your business grow. An AR collateral loan is for small business owners. Account receivables loans are short-term loans used to pay off accounts payable. They're often called accounts receivable collateral loans. They're perfect for small businesses because they don't require any personal guarantees. This means that your business doesn't need to be profitable yet to qualify for this type of loan. With an AR loan, you can use the money to pay off bills and expenses that aren't covered by credit cards or bank lines of credit. This allows you to keep cash flowing into your business instead of having to borrow against your assets. If you're looking for a way to boost sales and grow your business, consider taking out an AR loan. What type of accounts receivables loan do you need? An accounts receivable loan, also known as a factoring loan, is a type of financing that allows businesses to borrow money against invoices they haven't yet collected. This type of loan is often used when a company needs cash quickly, but doesn't want to sell its assets or go bankrupt. An accounts receivable collateral loan is typically offered by banks and credit unions. The lender provides funds based on the value of the invoices the borrower collects. When a business applies for this type of loan, the bank or credit union reviews the company's financial statements and determines whether it qualifies for the loan. The amount of the loan depends on the value of the outstanding invoices. If your business qualifies for an accounts receivable loan, you'll need to pay back the loan over a specified period. The interest rate charged on the loan varies depending on the lender. Typically, the longer the term of the loan, the lower the interest rate. Once the loan is paid off, the lender may require additional collateral. This means that the borrower must put up some sort of security, such as real estate or equipment, to ensure that the loan is repaid. Accounts receivable loans are popular because they're relatively quick and simple to obtain. However, there are risks associated with them, including the possibility of defaulting on the loan. In addition, if the borrower goes out of business, the lender may not collect any remaining invoices. You can use an accounts receivable loan to fund inventory purchases, payroll, marketing expenses, or anything else that requires immediate cash flow. But keep in mind that these types of loans aren't suitable for every business. Before applying for an accounts receivable collateral loan, consider other options, such as borrowing from friends and family, using a line of credit, selling assets, or asking for a short-term loan from a local bank. Understanding an accounts receivables loan agreement. This type of loan is typically used when a company has a large amount of outstanding debt, and its current cash flow cannot cover these payments. When a company receives an invoice, it must pay within 30 days. However, many companies don't receive payment until 60 days after the invoice date. This means that the company doesn't receive any money for at least 30 days. If a company does not receive payment within 30 days of receiving the invoice, it may be forced to borrow funds from a bank. These loans are called accounts receivable collateral loans. There are two types of accounts receivable collateral loans, secured and unsecured. Secured loans require the borrower to pledge certain assets as security for repayment. Unsecured loans do not require collateral. Secured loans are usually offered by banks, and unsecured loans are usually offered through third-party lenders. Once a company receives an account receivable collateral loan, it must repay the loan within 90 days. After repaying the loan, the company is required to continue making monthly payments to the lender. Accounts receivable collateral loans are beneficial because they allow companies to avoid bankruptcy. They also provide a way for companies to quickly access working capital. However, there are some risks associated with accounts receivable collateral loans, including interest rate risk, prepayment penalties, and late fees. Loans offered by banks. Banks offer loans to businesses to help them grow. But many small businesses struggle to qualify for bank loans because they lack collateral. That's where an account receivable collaterals loan comes in. This loan allows you to borrow against the value of your accounts receivable. This means that instead of having to put down cash, you can use your accounts receivable as collateral. An AR loan can fund any type of loan, including equipment purchases, working capital, payroll, or even a line of credit. And since banks often require at least $25,000 worth of collateral, this type of loan is perfect for growing businesses. Non-bank options. When you're looking for ways to save money, non-bank options may be just what you need. Non-banks offer many benefits over traditional banks, including lower rates, no minimum balance requirements, and flexible payment plans. If you're looking for a quick cash infusion, this is a great option. But be careful not to overspend. Make sure you budget for interest charges, fees, and other costs associated with the loan. How do I find out if my customer has defaulted on their payment? If you're not familiar with this term, it means that your customer hasn't paid you back for goods or services you've provided them. This can be a tremendous problem because when your customer doesn't pay you back, you lose money. And when you lose money, you don't have any money left over to invest in your business. Fortunately, there's a solution. An account receivable collateral loan can help you recover lost revenue and keep your cash flow strong. When does my business need an AR collateral loan? If your business is struggling to meet its monthly cash flow needs, an AR collateral loan may be just what your business needs. With an AR collateral loan, you can borrow money against your company's accounts receivable (AR) portfolio. This means that instead of borrowing money directly from a bank or credit union, you borrow money from your own AR portfolio. This allows you to access funds quickly when needed, without having to wait for approval from a traditional lender. To qualify for an AR collateral loan, your business must have at least $10,000 worth of outstanding invoices. The loans are typically paid back over 30 days to 60 days. Once your loan is repaid, you're free to use the money to pay down any other debts you have. What's in it for me? Account receivables. AR loans are a great way to finance your business. They're fast, flexible, and affordable. But there are some things you need to consider when deciding whether to use AR financing. If you decide to go this route, here are 3 reasons you should consider an AR loan. 1. You'll be able to grow your business while paying down debt. You might think that if you take out an AR loan, you won't be able to afford to make payments on your debt. After all, you're putting up your company's most valuable asset, your accounts receivable. But with an AR loan, you're actually using your accounts receivable to secure a loan. So rather than being forced to sell your assets to repay your debt, you're using your accounts receivable as collateral. 2. You'll have access to funds quickly. The fastest way to get cash is to ask your customers for it. With an AR loan, you can tap into your customer's accounts receivable right away. No waiting around for a bank loan officer to approve your request. 3. You won't lose money. Unlike banks, non-banks like to charge interest rates lower than those charged by banks. That means they often give you more flexibility for how much you can borrow. In addition, many banks require that you provide additional security before approving your loan. This extra step slows down the process and increases your chances of getting denied. An AR loan eliminates these unnecessary hurdles. Call 888-653-0124 today or click the link in the description to learn more.